Yo, what's up, everyone? Today we're going to be looking at a couple different dividend stocks that are actually at new 52-week lows. And I think, in my opinion, they are at good buying opportunities. And we're going to be showing you all the financials. Like, we're going to look at the debt to assets ratio, how much their dividend costs them, and see if they're diluting the shareholder or if they're buying back their own stock. We're going to be breaking all that down. So let's just get straight into it with the first stock being Tapestry. This one's kind of popular in the YouTube community, but look at the stock price of this one. It ain't pretty. I know, but right now they're actually yielding 4.91%. And they have a market cap of $6 billion. But yeah, let's just go ahead and dig into the financials together. So they actually are net income positive of $244 million. And they're a bit leveraged at 67%, but it's not too bad. It's down 1% from 1 year ago. But now we're actually going to see how much their dividend cost them. Remember, they had net income of over 200 million, and they can obviously easily afford the dividend. It only cost them $70 million. And what have they been doing with their extra money? They've been buying back their own stock. So this one's quite impressive, and the numbers are pretty good. So now let's look at the revenue forecast analyst expectations. So here's Tapestry. Remember, most of their revenue comes from Coach and Kate Spade, but look at this. Here's their revenue estimates. EBITDA estimates in 2 quarters is supposed to be up from 1 year ago, year over year. But yeah, nothing's really looking too bad over here at Tapestry. It's kind of following VF Corp, and this one's really bad. This one isn't on the list we're looking at today, but look at the stock price of VF Corp. This one's also a really high yielder right now. They own tons of brands. Like, let's see if it'll show us. Okay, they own like the North Face and Timberland and a couple brands like that. But yeah, let me know your thoughts on Tapestry. It might be at a good buying opportunity. And the next stock I wanted to show you is actually Norfolk Southern. So here's Norfolk Southern. Remember, this one was in the news a long time ago, and it's actually at that 52-week low level. And right now, it's not a super high yielder, but it's 2.66%. Now I'm going to show you some of the financials and show you why this one's not just a good dividend stock, but a good growth stock. So net income, it was down from year over year because of some, legal fees, but it's 819 million from 1 year ago to 356. And here, look at their operating cash flow, 673 million. Let's see how much their dividend cost them. It only cost them $308 million. That's nothing, man. That's nothing for this company. And if we go to their stock retirement program, if they didn't have that issue in Ohio, look at the stock retirement program. They've been buying back tons of stock recently. And it really was like 3 quarters ago, they were buying back almost $1 billion every single quarter. Yeah, I think this one in a year or two, when everything gets back to normal, people forget what happened. Well, I don't know if the legal fees will forget, but this one, I think in a couple years will be a solid grower. Remember, nothing in this video is financial advice. I'm just some random YouTuber. But yeah, let's get into the next dividend stock, which is actually ticker symbol TSN or Tyson Foods. So this one, it was really surprising. Look at the level of this one. It's almost at the 52-week low level. But yeah, I'm going to show you some of the stats. Right now, it yields 3.79%. Not too bad. It's in that sweet spot for a dividend yield. And well, unfortunately, they did have a net income loss in the most recent quarter. Look, they rarely, almost never have net income losses, but they did in the most recent quarter. But in all fairness, their assets versus liabilities are in check. It's not looking too bad. But we really want to look at the cash flow, operating cash flow here of $660 million. And remember, they have a dividend that literally only cost them $167 million. So not much at all. And if we go to yeah, they've been buying back stock. Yeah, so that's really cool. A lot of the stocks on this list are buying back their own stock, which is really good. It's basically the tax effective way of dividends instead of, the forced tax. You're only taxed when you sell, because whenever they buy back stock, it makes the EPS go up and literally makes the stock price go up. So yeah, we always love to see when they're doing stock buybacks because it's basically a tax-free dividend in the form of returns. So yeah, Tyson might be a little bit more risky because look at the EBITDA expectations. They've been actually missing it by a little bit every single quarter. These are the expectations, but remember, they've been missing the expectations. So who knows what's happened? Here's kind of the food segment breakdown. But yeah, let's go ahead and look at the next dividend stock. This one's not as risky as Tyson Foods. Now, I almost guarantee you've never heard of this stock. It is Cullen Frost Bankers. It's actually a bank stock, and look at the price of this one. The financials are golden for this one. So it yields 4.01% right now. and a market cap of $5.88 billion. I really like showing you guys new dividend stocks because I always think it's fun learning about it. So yeah, here's kind of their EPS, net income of 162 million. They are highly leveraged, but every single bank is the exact same way. Operating cash flow 154, but let's see how much their dividend cost them. Their dividend actually only cost them $58 million, which is nothing. I keep saying it's nothing, but it's really nothing when you look at it from their net income. And if we look at the retirement of stock, they bought back some of their own stock in the most recent quarter because the team knows that the stock price right now is at a great deal. And yeah, you could pick it up for a 4% yield right now. So yeah, and hey, if y'all are enjoying this video and appreciate how I show you all the numbers, I really would appreciate if you'd hit that like button and subscribe if you're new because we're trying to get to 1,000 subscribers. And if you look at the number, we're getting kind of close. And yeah, let's get into the next dividend stock. So the numbers for this stock are quite bad. This is Cracker Barrel, but I thought I'd show it to you anyway. It's at the 2020 fear pandemic lows. Cracker Barrel is only at a market cap of $1.4 billion. It yields 8%, bro. 8% over here at Cracker Barrel. But yeah, let's go ahead and look at the numbers. So they're actually making net income. Look, in the most recent quarter, $37 million. And for 78% assets to liability ratio, same from 1 year ago. So that's good. And operating cash flow of $100 million. So, they're not actually that bad of numbers. And their dividend only cost them $28 million, which is basically exactly what they made in net income. And if we go to their issuance retirement of stock, they used to buy back stock. So if we go to their total common shares outstanding, it's at 22.15. It is actually down from 1 year ago, so that's pretty cool to see. Oh my goodness, who remembers Cracker Barrel? That's so funny. All right, so now I want to show you another dividend stock. This one's at a multi-year low. You've definitely heard of it. It's Dollar General, and it's right now yielding 2.19%. But what's insane is this isn't just a dividend-paying company. They buy back stock like crazy. So look at the net income is down from 1 year ago, but it's not that bad because the assets versus liabilities ratio has stayed pretty much the same. But 535 million operating cash flow, and their dividend only cost them $129 million. And they've actually been buying back a ton of stock, not in the most two recent quarters, but look, 3 quarters ago, they bought back over $1 billion of stock. And the company's literally had a market cap of $23 billion. So in the coming years, I see them returning back to them buying back stock, and they could potentially raise the dividend if they wanted to. So yeah, that's Dollar General stock. All right, so for this next dividend stock, this one out of all the dividend stocks in this video, I feel is the most attractive stock out of all of these. So this is Public Storage, yielding 4.55% right now. And I'm going to show you the numbers. They're really good because it's in the self-storage industry. And so let's look at this. This is what we want to look at for REITs. This is the core FFO of $882 million, up from 1 year ago, and they're only leveraged by 42%, and that's down in a ratio basis from 1 year ago. But their total cash paid dividend only cost them $576 million. REITs are known to dilute shareholders because they like to raise capital by issuing shares, but Public Storage doesn't do that, almost having the same total common shares outstanding from 1 year ago. So I really love Public Storage. I think it's at a great buying opportunity right now. And it's at that 52-week low level, and you get a good yield. Yeah, guys, hope you enjoyed the video. I really would appreciate if you'd hit that like button and subscribe if you're new. We're trying to get to 1,000 subscribers. Let me know your thoughts on any of these stocks. Have you heard of all these, or maybe did I teach you anything? Let me know in the comments, and hope you have a great rest of your day.